Ladies and gentlemen, good day and welcome to Q1 FY23 earnings conference call of SBI Life Insurance Company Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mahesh Kumar Sharma, MD and CEO, SBI Life Insurance Company Limited. Thank you and over to you, Mr. Sharma. Members of the management, you may go ahead with the call now.
Yeah, thank you very much. Good evening, everyone, and we heartily welcome you all to the results update call of SBI Life Insurance for the quarter ended June 30th, 2022. An update on financial results can be accessed on our website as well as on the websites of both the stock exchanges. Along with me, I have Sangramjit Sarangi, President and CFO, Ravi Krishnamurthy, President Operations and IT, Abhijit Gulanikar, President Business Strategy, Shubhendu Bal, CRO, Pritesh Chaubey, Appointed Actuary, and Smita Verma, SVP Finance and Investor Relations. Now let me give some key highlights for this quarter ended 30th June 2022. New business premium registered a growth of 67% year-on-year and stands at 55.9 billion, leading to a private market leadership. Individual new business premium stands at 34.3 billion with a strong growth of 87% and private market share of 24.5%. Gross written premium stands at 113.5 billion, growth of 35%. Protection new business premium grew by 63% to 7 billion. Profit after tax stands at 2.6 billion with an 18% growth over corresponding quarter last year. Value of new business is 8.8 billion, registering a strong growth of 130% over 3.8 billion in June 2021, and the VNB margin is at 30.4%, which is an improvement of 665 basis points over 23.7% in June 21. We have aligned the value of new business and VNB margin for quarter ended 30th June 2021 in line with the 31st March 2022 disclosures. Assets under management grew by 13% to 2.623 trillion. Robust solvency ratio of 2.21 against regulatory requirement of 1.5. I would also like to highlight on a few key initiatives taken by the company. Considering and keeping the pace with customer needs, we have launched SBI Life Smart Annuity Plus. It offers a comprehensive range of annuity with an option of deferred annuity payout. With a view to broaden our reach, SBI Life has tied up with Paschim Banga Gramin Bank, a leading RRB in West Bengal. We have also signed an agreement with major fintechs, Renewbuy and PhonePe, PhonePe Insurance Broking Services Limited, to be agile with changing customer behavior. With this, we have successfully delivered customer-centric profitable growth in this quarter as well. We will now update you on each of the key elements in detail. Let me start with the premium. Being one of the prime focus areas of the company, individual new business has grown to 34.3 billion with a growth of 87% year-on-year. Single premium contribution is 28% of the individual new business premium, which is mainly attributed to growth in individual annuity product. The company gained the private market share by 569 basis points to 24.5%. On individual rated new business premium, we stand at 25.8 billion with a growth of 86% and private market leadership with a share of 24%, having improvement of 511 basis points over the corresponding quarter last year. Also, group new business premium stands at 21.6 billion with a growth of 43%. Having said that, we have collected total new business premium of 55.9 billion, registering private market share of 21.9%. The renewal premium grew by 14% to 57.6 billion, which accounts for 51% of the gross written premium. To sum up, Gross written premium stands at 113.5 billion with a growth of 35%. Total APE stands at 29 billion, registering a growth of 80%. Out of this, individual APE stands at 26.1 billion with a growth of 87%. During the quarter ended June 30, 2022, total 4.14 lakh new policies were issued and registered a growth of 61% over the quarter ended June 30, 2021. Individual new business sum assured registered a growth of 52% over the corresponding quarter last year, as compared to growth of 6% at private industry level. Considering the adverse impact of COVID-19 in Q1 FY22, followed by a strong performance in subsequent quarters of FY22, we expect a steady growth in our performance over the coming quarter and to end the financial year 2023 on a strong, healthy note. Coming to the product mix, we are happy to report that the company has seen strong growth across all product segments. Our guaranteed non-par savings products are contributing 23% of individual new business premium, and on the total APE basis, this contributes 28%. Non-par guaranteed product new business has registered a growth of 621% YOY, mainly due to the new business contribution of Smart Platina Plus, a new product which we launched in March last year of rupees 6.1 billion in the quarter ended June 30, 2022. This product was launched in March and has seen a strong traction in the new business premium, mainly due to the product features witnessing high acceptance in the market. ULIP has remained one of the flagship segments for the company. Individual ULIP business is at 17.6 billion, which constitutes 51% of individual new business premium and at 42%. Individual protection is at 2 billion, registering a growth of 55%. Group protection stands at 4.9 billion with a growth of 66%. Credit life new business premium has grown by 73% and stands at 4.1 billion. On APE basis, protection contributes 11% of new business and registered a growth of 46%. Annuity business is at 6.5 billion and contributes 12% of new business premium. Total annuity and pension underwritten by the company is 11.6 billion, registering a growth of 7% over quarter ended 30th June 2021. Group fund management business is at 15.2 billion with a growth of 93%. On our distribution partners, we have a strength of more than 54,000 CIFs. SBI and RRB bancassurance business contributes a share of 65% and grew by 107% in individual new business premium, and on individual APE basis, it stands at 17.4 billion with a growth of 100%. Agency, another strong channel, registered new business premium growth of 50% and contributes 17% in new business premium. Agency channel individual APE stands at 7.6 billion with a growth of 64%. As on June 30, 2022, the total number of agents stands at 1,61,923. There is improvement of 61% in the agent's productivity levels on individual NBP basis as compared to the corresponding quarter last year, and greater use of technology is assisting in better engagement in the entire value chain from recruitment and training through to lead generation, sale and customer service. During the quarter, other channels grew by 82%. This constitutes direct corporate agents, brokers, online and web aggregators. So this grew by 82% in terms of individual new business premium and 89% in individual APE. Protection new business premium through other channels registered growth of 23%. Partnerships like Indian Bank, UCO Bank, South Indian Bank, Punjab and Sindh Bank and Yes Bank registered a growth of 125% overall. These partnerships have started contributing 3% of the individual new business premium. On profitability, the company's profit after tax for the quarter ended 30th June 2022 stands at 2.6 billion with an 18% growth YOY. Our solvency remains strong at 221% on June 20, 2022. Value of new business is 8.8 billion with a growth of 130% YOY as against 3.8 billion in the corresponding quarter last year. VNB margin is at 30.4% vis-a-vis 23.7 in Q1 FY22 with an improvement of 665 basis points. Growth in VNB and VNB margin is fueled by significant new business premium growth, and change in product mix with predominantly non-par guaranteed savings segment growth. With our growth targets and product mix shift, we expect to maintain the healthy VNB growth rate. On operational efficiency, OPEX ratio reduced to 6.6% for the quarter ended 30th June 2022 from 7.2% for the quarter ended June 30, 2021. Our total cost ratio stands at 11.2% for the quarter ended 30 June 2022 vis-a-vis 10.5% for the same quarter last year. With respect to persistency of individual regular premium and limited premium paying policy, 13th-month persistency stands at 85.6%. Company has registered a significant improvement in 49th-month persistency of 403 basis points. We have witnessed fair growth in almost all the cohorts. As mentioned in my opening remarks, assets under management stands at 2.6 trillion as on June 30, 2022, having growth of 13% compared to the last year same quarter. The company continues efficient use of technology for simplification of process, with 99% of individual proposals being submitted digitally. 40% of individual proposals are processed through automated underwriting. To conclude, we are focused on striding ahead against all odds by building a robust value system and foundation that are an amalgam of multiple forces, including our investors, customers, distributors, and our own people and other stakeholders. As we move forward, digitalization and automation will remain the core of ensuring customer satisfaction. We continue to aim towards sustainable and profitable growth in the long term. Thank you very much, and we are now happy to take any questions that you may have.
Thank you very much. We will now begin with a question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking your question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhaval Gada from DSP Investment Managers. Please go ahead.
Yeah, hi sir. Congratulations on strong numbers. I just had a couple of questions. First is relating to the non-par segment. So we've seen very strong growth this quarter. If you look at like FY22, we did about 1,700 crore of new business premium. Already in 1Q, we did about close to 800 crore. I just wanted to understand, this product mix shift that we see. Do you see it sustaining throughout FY22? Do you see far more traction of Smart Platina Plus for the rest of the year as well? Any thoughts, comments around that?
Yeah, so this is a product which we found was customer driven. It's a product which customers wanted. Our Platina Assure, Smart Platina Assure, which we launched earlier, also was doing very well. And this is a variant where you have income. So that income product we felt that we didn't have in our bouquet, and we introduced that. And the customers have taken. It's got very good traction. I think going forward also there will be good traction for this, and therefore I'm sure that there will be more non-par Platina being sold going forward.
And sir, what's the margin differential between company margin and this non-par segment margin? Like you mentioned in the presentation that a large part of the margin shift that we've seen is
obviously higher. We don't want to go into exact numbers. We don't give out exact numbers. But then the idea is that it is definitely very margin accretive. So it is definitely there.
Understood. And so the second question is around the operating assumption change. You mentioned in the margin slide, the margin walk, that there have been some negative operating assumption change. If you could just specify what drove that, that would be useful.
See, just to clarify, we have not made any change in our operating assumptions or methodologies. Assumptions remain unchanged as we have used in the 31st March 2022. Since we are giving this walk from the last June to this June, this March changes are coming. This is part of the normal exercise that we always do at year end, and the changes, and this is mainly on account of mortality and insurance that we explained in the March call.
Got it. Understood. And sir, the last question is relating to the reserve that we have towards the COVID-19 pandemic. How do you see this evolving at the end of the year? Do we see write-backs in the fourth quarter, if any, or we'll use during the course of the year? How do you intend to utilize these reserves?
Frankly speaking, I need a crystal ball for this because, last 2 years also, we had made some provisions for COVID related things. There was one wave, second wave, third wave. So, we really don't know how the whole thing is going to pan out. As far as I can see, there is a very strong vaccination program in the country which is very successful. Our hospitalization and mortality rates have come down hugely because of this pandemic, which were attributed to the pandemic. So, naturally speaking, if the trend continues, yes, this whole thing could be actually superfluous and we could actually write it back. But right now, I can't predict, So, with 2 years experience of the pandemic, we have actually kept this reserve. I think it's a very prudent way of doing things going forward. In any case, I think one of the things that every insurance company will do going forward, and I think every company in the world is going to do, is going to keep a slightly higher pandemic reserve than we were doing earlier. So earlier in 20, when the pandemic struck, we had a reserve of 42 crores or something. I don't remember the exact number right now, but I think it was around 42 crores. Today, we know from experience that we needed much higher amounts when actually a pandemic struck. So, even with that point of view, I think we need to keep a higher amount as a reserve. So, I think that is how I look at it.
Got it, sir, and wish you all the very best. Thank you.
Thank you very much.
Thank you. The next question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Thank you for the opportunity, sirs, and congrats on a great set of numbers. First question is again, sir, on the traditional savings products and particularly through the banca channel. I think banca has generally been heavily skewed towards the ULIP products, and this quarter that has been kind of now the mix has moved towards this traditional savings. So is this a strategy that we are going to see through the banca channel going ahead also, or if the sentiment related to the ULIP comes back, in general, we are hearing that there is some amount of weakness for the ULIP product in the industry. So if the sentiment comes back, then will the mix revert to the earlier kind of set of numbers? If you could throw some light on that.
Yeah, so I think my answer would be what I have been saying quarter after quarter for the last many quarters, that we don't actually determine consumer behavior. So this is a product which we have launched, which has got acceptance with the public. I think there are circumstances which are encouraging people to go for guaranteed return products, but ULIP is also growing. So, if you can see vis-a-vis last year, same quarter, our ULIP has grown by 42%. And it's not a small this, even though there was a base effect. But still, even if you didn't have the base effect, you will still find that there was some growth over what would have been the ULIP numbers. So that way, I don't think that we would like to fix the customer preference. And right now, as we see, there is a good demand, and this product probably people were probably waiting for from our stable, and that is why you see this very good demand. And not only in banca channel, I think you are reading it wrong. We have the same kind of demand in the agency channel also. And the agency channel is very different from the banca channel, just like chalk and cheese, So I don't think there is anything to do with the bank customer or anything aspect. People are finding it a useful, good product, good return, and that is what I think is helping the product.
Sure, sir. Helpful. Sir, in terms of PAR also, will a similar comment apply? Because PAR, what we have been seeing is that it was slightly debit in the past few quarters, and it has now come back very strongly this quarter. So, has there been any new product introduction in PAR or?
PAR, PAR, I think there was a shift from PAR to non-PAR. I think in the last couple of years, you would have seen that as our non-PAR Platina grew in popularity, I think we had some loss in the PAR because, I think the whole market is probably related. So, right now we have very good products. I think it's only a question of the customer exercising the choice, and our training of our own agents and all, it does help them to refresh some of the products that are already in the stable. And sometimes what happens is that you have that aha kind of movement, and the agent thinks that this is something which my customer would like very much, and then it starts clicking. So this is, I think that is all there is to it. But from what we see from the ground, and we have asked these questions very pointedly to our marketing people, and we find that there is more requirement for PAR. And going forward, I think this will also grow slightly more, at least from this level, it is going to grow.
Sure, sir. Sir, what is the share of the new product in non-PAR out of the total non-PAR APE?
30%. Yeah, 30%.
Okay, sir. And couple of data points, if you could, sir, share. Generally, you have shared this in the past calls. So the split of group protection under group credit life and group term life, as well as for individual protection under TROP and pure term, if you can give the mix.
I request that we send you the figures, because right now I'll have to actually look for it in the doc that I have. So can I send it across to you offline?
Yes. Thank you,
Pranab.
Yes, thank you so much, sir.
Thanks, Pranab.
Thank you. The next question is from the line of Adarsh Parasrampuria from CLSA. Please go ahead. It seems to have lost his line, so we'll move to the next question, which is from the line of Sanket Kodha. Please go ahead.
Thanks for the opportunity. Sir, you said that the non-PAR business, which is 28.3% of the total APE, out of the total non-PAR, 30% was contributed by new product launch. That is income plan, right, sir?
Yeah.
And what would be a margin profile of an income plan compared to a non-PAR product in that sense? And I just wanted to understand, in the past we have said that the non-PAR probably will not be more than 15% of the total APE, because it spoils the distribution setup if we do a lot of non-PAR, if the cycle is not in their favor. So now it is 28.3% of the total business. From the full year point of view, do you expect this 28.3% to moderate to like 15 to 20% for the full year, sir?
Yeah, I don't know. I mean, for looking at the trends, I think that it should be, around this level, say 25 to 30%. I think that would be my own intuition on this. And as far as the margins are concerned, I think it's almost, it's all comparable. It's not.
Got it, sir. Sir, somewhere we have struggled in the current quarter with respect to the annuity business, because it's flat year on year. both in AP terms and in individual new business terms. So it is more a slowdown in the business or it is in the individual business?
The annuity, I think, annuity has grown by
Annuity grew by 3%.
3%.
Okay. Overall, annuity, if you see, the focus is there, and overall pension and annuity business has grown by 18%.
Yeah. So pension and annuity business has grown by 18%. There is definitely a focus out there. But then, like I said, some of this will depend a lot on the customer demand also.
Got it, sir. And finally, sir, just on when you say pension product, it is predominantly ULIP pension product. That's what you are referring to, or because when we look at the other peers, ULIP has struggled for everyone because the market being little choppy. Everyone has struggled to grow the ULIP business. So in our case, it seems to be still very decently very good. So just wanted to understand.
ULIP business depends a lot on the returns that you give to your customers. It doesn't depend on whether you're not trying to actually sell ULIP to people who don't want it. We sell ULIP to people who understand the product, and therefore they also understand how much they need to wait for, and also sometimes the market fluctuations will be there. And they have options to choose between various funds, including debt, equity, balance. So there are so many kinds of funds that we have, and each of those, so we see some shifts, going from one to the other or something. But I have to say that right now our equity portion has grown rather than debt over the last couple of years or so. Going forward, I don't know how much that will sustain because markets have not been very good. But then, if people understand markets, then maybe this is a good time to invest also.
But within this ULIP, how much portion would be ULIP pension for us?
ULIP pension, 1 second, let me check about pension.
We'll come back to you, Sanket.
Yeah, so we'll have to come back to you with that figure.
Okay. And sir, last one. In the non-par, which is 30% is an income plan right now. Given it's a new launch, whether it might become higher contributors in the entire non-par pie going ahead, given the traction will be there in this particular product, and we believe that income plans generally have a better margin profile than the non-par plan. So 30%, how do you see it to improve going ahead, or it will remain at these levels only?
Oh, very difficult to predict, boss. But if you see the demand, then maybe it'll actually grow a little more on that product than on some of the other products that we have. Having said that, all other products also are seeing good demand. So in spite of the very strong growth, if you look at the growth figures in the segment, then it is not only this product which has grown, but this is a new product. And obviously, the latent demand would, get satisfied earlier than later. And then after that, it will probably settle into a pattern. I really cannot predict the pattern, but I suppose there will be some more growth in this product going forward.
Got it. And sorry, last one, sir. How much of this non-par is backed by FRA and how much is backed by CPD, sir?
So we have both the products, partially paid bonds and FRAs, and we are doing a hedging depending on the kind of requirement that we have and our own policy of hedging. So we are in line with our policy of hedging.
Got it, sir. Yeah, that's it from my side. Thank you.
Thank you very much.
Thank you. The next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead.
Good evening, and thank you for taking my question. So just first one on the protection business. I think retail protection, we have seen 50-60% growth. So this continues to be a slightly outlier to some of the peers who are seeing decline. So if you could just walk us through some of the dynamics around what is driving us market share gains in ROP. Are we just harvesting our own customer pool, or are we able to compete effectively with external customers as well? So some thoughts or color there will be helpful, sir.
Yeah. So, if you look at our production growth, we have had a decent production growth in our agency channel also. And so, that is, if you want to talk about competition, that is competition. You have to go out in the market and get it. The demand is there. And our growth, if you look at the requirement in India for protection, there is a huge protection gap. So almost everybody needs protection. Now our growth in protection is 47%. And that growth comes out of selling good products. So we've been saying this earlier also. I think the earlier questions used to be, why are the others able to sell more? Why are you not selling as much as the others, and things like that? So we always used to say that we have a steady growth because we are looking at the customer's need and we are fulfilling that need. Again, the same question used to be for the term with return of premium. And, there was this halo around pure term insurance. You can see what has happened to, pure term insurance. There are some things which are not sustainable and some things which are, probably foisted on people. So, this TROP is something which is an ideal product for India, and I think we have hit a very sweet spot where people understand this product, and people also understand that if they survive, they get something back. Okay, these are two things which help to spread insurance awareness also in the market. So, I think we should say that rather than being outliers, we are the pioneers in doing this spreading of insurance in a sensible manner.
Got it, sir. That's helpful. So second question is on guaranteed. I think you called it out as 23% of total APE, right? So it seems to be relative to your own past. That number has jumped up quite a bit, quarter on quarter, even year on year, right? So what is the comfort level in the sense that you talked about your hedging? You said that it's under as per policy, but we can't write unlimited number of such policies, right? Maybe there is unlimited demand.
If I can hedge everything, I can write unlimited. Okay. So, so that is the main thing. So very comfortable as far as our position right now is. Okay. And as far as we are able to do that and customer demand is there, I think we will continue with this approach. Plus, of course, the recalibration will come in terms of pricing. So what happens is that, when the interest rates grow in the market, the expectations grow, then you reprice the product, then it depends on how much you reprice it, whether you are in line with the market, whether you are more than the market, whether you are less than the market in repricing. So that will also determine what kind of growth comes. So these things will be determined by the demand, what the customer needs, and what we can sustainably do going forward.
Sir, last question on this, just a technical. So average duration on this portfolio, if I look at your presentation, seems to suggest a very 20 plus years kind of a duration. Is that right, or you have a limited pay which actually makes the average duration on that portfolio lower?
See, this is a limited pay. So maximum premium paying term on the product is 10 pay for the income plan and 7 pay for the endowment plan. So duration can't be for 20 years. It should be much lower than that.
Got it, sir. Thank you and all the best.
Yeah, thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please submit your questions to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Adarsh Parasanpuria from CLSA. Please go ahead.
Hi, sir. Sir, I'll have a follow-up on the previous question. The constraint on what you can sell, given that you're seeing demand will be on hedging.
So sorry to interrupt you, Adarsh. Your audio is not very clear. I would request you to come on the handset mode.
Okay, yeah, I've just moved. So, sir, the question was a follow-up on the previous one. So, you've had a spectacular result, a lot of it driven by the mix change. The only constraint always for every player is the hedging. And since you believe that a lot of these momentum that you're seeing can continue, it'll really help all of us if you could, in a little bit more detail, explain your hedging policy. And because for us it'll make your margin outlook a lot more sustainable if there is a very effective hedging policy on this.
Yeah. So see, what happens is, what are you hedging against? So you are hedging against a change in the interest rate. Okay. So what is the period that you need to hedge for? The period up to which you are uncertain about the inflows. Okay. So the inflows will come at a future point of time, and at that time you don't know what is the return you are going to get, and that is what you are hedging. So till there is visibility, let's say in the next year, 2 years or whatever, at any given point of time, the kind of visibility that we have, we would be comfortable in investing directly for that portfolio. And anything beyond that, what will happen is that we'll have to wait and watch what are the inflows and what is the rate at that point of time. So then instead of waiting and watching, we hedge that. So that is exactly what we are doing right now. I don't know if that gives you the clarity that you're looking for.
Sir, what we are saying is, for year 3 onwards, whatever are the expected premium inflows, majority of the inflows are hedged. We will not be able to share percentage, but majority inflows are hedged, and that is as per board approved policy.
Sir, if you could just throw some light on what's the premium paying terms in most of these policies, like what you've sold, this 800 crore, approximately a ballpark number of what the premium paying term is. Are these like 5-7 years only, or are these mostly longer products?
7 to 10 years.
7 to 10 years.
So the product is 7, 8, 10.
Got it, sir. So now coming to the second question, obviously if you believe you can deliver similar momentum or in the same vicinity, maybe about 6 months back you all guided to a 30% margin over a 3-year period, and we are like 5th quarter or just starting FY24 and your margins are north of 30%. And if you sustain this product mix, then obviously the margins look sustainable. So just wanted to understand how you all are looking at it, how the board is looking at it, because this is a phenomenal jump in margins, and just wanted to understand how sustainable it looks to you all.
So margin is not something which we are chasing per se. We are looking at the bigger picture. We need to have the value of new business go up. We need to have the EV go up. So that is what will show that we are growing as a company and we are going in the right direction. And margin is one of those factors, So margin, I will not be stuck on a particular number for the margin, because going forward, if I sell more of some of the other products, for example, ULIP, if I sell slightly more of ULIP, then the margins can, slightly come down from this level also. But then the value that I deliver will continue to grow, because we are looking at good growth going forward, upwards of 25% growth in premiums, and I think that is something which we think is sustainable as we see it now. We have done extremely well in the last couple of years, given that there was a pandemic and we had virtually zero business in some of the months. At least for weeks we had some much lesser business. So we think that we will be able to sustain that. Nothing is unlimited, but if you look at the potential that you have in India, it's humongous. The potential that you have for insurance is huge. Almost 82% of the people are not covered to the extent that is required. The protection gap is 82%. And if you look at the coverage of insurance to GDP, 3.2%. So, the scope is vast. So it can literally, actually, the whole business can grow to anything from here.
Got it, sir. This is helpful. Thanks.
Yeah, thank you.
Thank you. The next question is from the line of Avinash Singh from MK Global. Please go ahead.
Yeah, hi. Good evening. A couple of questions. Firstly, on your, accounting profit, I mean, coming from that last year's base when there was a kind of a huge COVID Delta wave losses, the profit accounting terms, of course, not a very key number, but looks a bit muted. I mean, so is that largely an impact of, higher new business strain because of the change product mix? And
Yeah, absolutely. You got it on the button.
Okay. And the second, in terms of your distribution, I mean, of course, you have typically, a very gradual, branch addition track record and kind of sustainable. Now you are close to 1,000 branches, and of course, your largest bank distributor is omnipresent almost across India. So now, I mean, in terms of branch addition, is now you are done, you are going to stop, or your own branch addition will also continue at the same pace you have been doing for the last couple of years?
So we have been growing at a very, sensible pace, I should say. We look at the potential that is available and any areas which we have not covered earlier, where we think there is good potential, or any area that has got very good potential and we have inadequate staff or representation out there. So those are the places that we grow, and I think we will continue to look at it in the same fashion. We have never had to open branches and then close them. So, we do have a very good approach to this whole thing. We do a very scientific analysis of the kind of business that is available, and then we grow that. So the branch network also, I think at least as of now into the near term even the mid-term foreseeable future, I don't think we are going to actually stop expansion. So expansion will be there, but as you can see, the numbers are not huge. So we probably add about 30-40 branches every year, and that is I think very, very sustainable.
And one data keeping, I mean, what sort of a run rate currently your individual term is seeing on YONO platform? I mean, is some momentum continuing or has sort of the momentum come to a halt?
Yeah, there is a good traction on the YONO platform, and this year we have taken good targets for the YONO ILS also. So that is something which we will continue to focus upon.
So what's the current run rate on protection side? I mean, on retail protection on YONO platform?
Currently all our YONO, we are only selling protection actually.
Yeah, right now we have only protection on YONO, no?
Yeah.
On YONO app, we have one product that is a protection, pure protection.
Yes. So what is the premium run rate? Any sort of a number?
Premium? Yeah, why not?
Premium at this moment it is very small, but we are eyeing for a big number along with other products going to be introduced in this platform. So in this year we are expecting good jump as far as the YONO platform is concerned.
Okay. Thank you, sir.
Thank you. Request participants to please limit your question to 2 at a time. The next question is from the line of Neeraj Toshniwal from UBS. Please go ahead.
Hello. Congrats on great set of numbers, sir. Just wanted to know, last year in August we did repricing of both non-par product and the term insurance plan, and we told that another year we won't be changing anything, especially for the non-par protection. Where are we in terms of repricing both the products now? So we already have launched a new variant of the non-par saving. What are your thoughts, and are we looking to maintain our spreads there with the rising interest rates and with the FD rates going up? How we are thinking about it?
So like I said, for the non-par savings products, our pricing will depend on the market conditions, the interest rates. So going forward also, we'll keep a look at the interest rate movement, and we don't want to be very far away from the market.
Just to add that, I keep mentioning that we do follow very active pricing for all our non-par products, particularly in view of the interest rate movement and our term and condition on which we are getting the forward rate agreement on their side. Accordingly, we are actively repricing, looking into the market scenario, and our our objective is to optimize the value both for the customer and for us. And intention is to maintain the spread that we are getting today. So as long as we are able to maintain this spread and able to hedge this interest rate, I think we'll continue to keep doing that. So difficult to comment that when we do that. We are continuous pricing, so one by one, as and when required, we keep repricing.
Okay, and more color on the protection will be helpful, as in to understand, because now the whole industry is now, doing ROP, similar to what you are doing. Has competition really increased, or it doesn't affect us because our reach is much?
I don't think it affects us much, because, we are expanding the market, we are going and, selling. These are products which people, new people who are not covered by insurance are buying. And if they see value in the product, they will continue to buy that. And we will be looking at the pricing to make sure that, it is sustainable for us and it is viable for the customer.
Got it. And last question on ULIP. Want to understand, though we have done well in terms of YY growth, but it comes from low base. So where do we think the ULIP kind of settling for the full year, given overall the industry is struggling? We have done relatively better, but still it will be helpful because
I think ULIP should be somewhere around 55% around, so this could be say somewhere around 50 to 60%, but ideally my own feeling is that it would settle somewhere around 55 to 60.
Got it. That is helpful. Thank you so much.
Yeah, thanks.
Thank you. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good evening, everyone, and congratulations on an exceptional set of numbers. I have a few questions, and sorry I joined in a little late on the call, so I may have missed this if it's already discussed. First, do you have some sort of limit for how much non-par you could write? I understand that there is a lot of demand, but internally, have you sort of kept a limit for yourself that of my entire product mix, this is the extent to which I'm okay writing non-par? Second, there is a change in assumptions which has impacted margins by about 50 basis points. What is that? Third, on the individual annuity business, can you, so my calculation suggests that we've done about 60 crores. Can you just verify that? And finally, the next 2 quarters were very strong sort of last year. So now the base is very high for us going into the balance part of the year. And we're hearing some talk about a rural slowdown. Maybe you can give us some context, some commentary around the demand environment and how confident you are of growing on this base for the balance part of the year.
Yeah, so first let me talk about your individual annuity. Yes, you have a correct figure. I think it's around 51 crores on individual annuity. And as far as the limit to the non-par is concerned, we don't have an internal limit. But my own sense is that, we would be around this kind of a level, maybe 25 to 30% of our portfolio, because I do see the other parts also growing. So all of it is growing. When you come back to growth, then as of now, we obviously there is a base effect to all these numbers. So I don't think we'll continue to grow at 87% or something in some of the things. But our target is about 25 plus percent, and then after that sky is the limit. So 25% is what we will aim to have, and my sense is that we should get there. Coming to the assumptions, I'll ask Pritesh to.
There is no change in assumption in this quarter. The impact that we are seeing in the VNB walk is the assumption change that we have done in the month of March for year end. If you're showing this walk from December to June to this June, this impact is coming from. But there is no change in assumption methodology. And the changes that we have done in the March is mainly on account of insurance, tightening some of the things and modality, nothing else.
Got it. Understood.
Thank you very much.
So 25% on last year's base.
That is what we are targeting, yeah. For the full year.
Okay. All the best.
Thank you.
Thank you. The next question is from the line of Deepika Mundra from JP Morgan. Please go ahead.
Good evening, sir, and congratulations on a great quarter. So just want to understand at the product level margin, is there any product where the margin is changing, particularly on non-par? Are you seeing, significant benefit of higher spreads, which is helping the margin other than just the mix increasing?
So, like we said, we'll try to optimize the prices so that we also have a sustainable product and the customer also gets value. So I don't see sudden changes, in that kind of thing.
Understood, sir. That is the only question. Thank you.
Thank you so much.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Mahesh Kumar Sharma for his closing comments.
Yeah, so I'd like to say that, thank you so much for supporting us. And we hope to continue to deliver, all those expectations that we have from all of you and from our customers. And going forward in this year, if we have a COVID-free year, and if there are no other major disruptions, which I sincerely hope there won't be, I think we'll be able to, come up with a good performance by the end of the year. Once again, I thank all the stakeholders, all our friends here on the conference for listening patiently to us. Have a great evening and wish you a very safe and healthy future. Thank you.
Thank you. On behalf of SBI Life Insurance Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.